New Delhi, who will be speaking on compromise and arrangement under Companies Act 2013. And I think with coming of the IBC, compromise and arrangement has gone for a 360-degree rotation. And we are very happy to have you, sir, over here. I think this is your first session you are taking for ACAE. Correct, Satwinder, sir?
Yes, yes, yes.
So let me just give a brief background. ACAE is an organization which is around 62 years old. And ACAE has been there in public with chartered accountants, company secretary, and professionals. We take privilege in introducing ourselves as a body of corporate professionals. Association of Corporate Advisors and Executives is one of the oldest professional body in Kolkata, sir, which comprises of CAs, CS, advocate, legal experts, corporate consultant, industrialist, and businessmen. We were formed in 1960, and we had a real celebration in our 60th year in the presence of late Pranab Mukherjee as chief guest, past President of India. Since inception, ACA has crossed a number of milestones. It had various luminaries present in various programs like Professor Sukumar Bhattacharya, late PM Narialwala, late MC Bhandari, and other reputed person as its president over years. ACA has also seen the presence of various central and state ministers like late Morarji Desai, late Pranab Mukherjee, late Jayaprakash Narayan, late Somnath Chatterjee, as well as various Supreme Court and High Court judges and senior bureaucrats. Today, because of the extraordinary contribution of its past leader, ACE has a towering standing in the Committee of Professional Bodies. Today, corporate and professional world is facing immense challenge in a fast-changing legal, technical, and global business environment. And with the COVID-19, which has acted as a catalyst to take information technology a forefront, ACA is happy to announce that on 10th of September, it is organizing an annual conference, one of its kind in East India, with a theme DIA, D-I-A, digitalization, institutionalization, as we all have to work together to grow, and artificial intelligence, because human intelligence is there, but if supported by artificial intelligence, it can take the next leap and be above the learning curve. And we all are very happy to also inform that AC organizes the only corporate award in East India. We present the annual ET Bengal Corporate Awards, and the event is attended by dignitaries such as Shri Piyush Goyal, Shri Sachin Pilot, Shri TV Mohandas Pai, Shri Amit Mitra, Shri BK Billa, Shri Sachi Goenka, Shri R.S. Agarwal, Saroj Poddaji, Yogesh Chandra Deveshwar, the past chairman of ITC, Shri Sanjeev Puri, Kishore Bianiji, Harshvardhan Neotiaji, and Dr. Arvind Panagadia. So presently, the total membership of ACA is around 1,400 members, having various life members, honorary members, patron members. And during COVID-19, we were happy to have 2 sessions every day, ACA at 11 a.m., ACA at 6 p.m., where we had various programs during lockdown, and our members were happy to be involved and attend the programs during COVID. With this brief introduction of ACA, I would welcome Advocate C.S. Satwinder Singh and request Mayur Agarwal, a very young, talented regional council member for ICI EIRC and a very proactive member of ACA, to take over from here. Over to Mayur.
Thank you so much, President. Good evening to all. First of all, friends, I welcome you all to this 2-day conclave on corporate law. The theme of the conclave is Decoding Compliance and Complexities. We know, friends, that be it any act, we talk of Income Tax Act, GST, Companies Act, every week we see a lot of notifications, amendments, clarification, and with day by day, with all this clarification and everything, complexities are increasing day by day. From business perspective, always they will say that compliance burden is increasing. From government perspective, they say that they need to plug all those loopholes. That's why they are coming with all these amendments day by day. So everyone has a different perspective. We as a professional can say, some of the professional at times say compliance burden are increasing. Some look these increase in compliance and complexities as opportunity. So everyone has different perspective to all those things. So that's why we have kept this as a theme of this 2-day corporate conclave, where we have 5 speakers as already explained by the president. I would take this opportunity to introduce our first speaker, Advocate Satvinder Singh ji. He will be speaking on compromise and arrangement under Companies Act. So Mr. Satvinder Singh is founder and managing partner at Acae legal firm, a lawyer by profession. He is also a qualified company secretary, a registered insolvency professional, and certified associate of the Indian Institute of Bankers. He has extensive experience in handling corporate law matters, including mergers, acquisition, corporate restructuring, revival, rehabilitation, insolvency matters, joint ventures, collaboration, private equities, and the list goes on, friends. Mr. Singh has been appointed as member of Appellate Authority constituted by notification dated March 25th this year, issued by the Ministry of Corporate Affairs, Government of India. He is also the chairman of expert group on secretarial standard set up by ICSI, with members representing SEBI, NSC, BSC, chambers, and company secretaries of large organization. Mr. Singh was also a co-chairman of restructuring and insolvency resolution practice group set up by the World Law Group. He has been authored to many books. We welcome you, sir, to ACAE, and over to you, sir, for your deliberation.
Thank you, Mayur, for the nice introduction. In fact, the name ACOM, which you see we set up recently after my experience of over 32 years with the full team, that was only taken from Gurbani and Ekam Kar, or God is one, it's all pervasive. So that's how we think that, okay, that is where the ethically we have to work, and that is the purpose where we have to advise people, and with the name of the God, everything will goes fine. And I'm sure that today, if we are taking up this session, the Ma Saraswati will definitely bless all of us, because we all are taking out time out of busy schedule. क्योंकि मैं हमेशा यही कहता हूँ कि लक्ष्मी और सरस्वती कभी दोनों इकट्ठी नहीं आती, and if you have a blessings of Saraswati, Lakshmi will always follow. So that is where I always feel that, okay, let us look at it, let us discuss, let us see. And I'm thankful to the Association of Corporate Advisors. I'm thankful to Rahul Parsuram-Puria, who called me up after perhaps listening my session in Ranchi the other day. And on Monday, he called me up that we would like to have me in the session. So I thought that, okay, let me just join. So with this, thank you so much. I know that this session which we are taking, it's an online session. But I would love to have the participation from all of us, because this is the topic which I will definitely look at it, because this is the, as my friend has talked about, that what the Association of Corporate Advisors and Executives is. So it shows that, okay, I have the opportunity to address the elite audience who are already knowledgeable, who knows the subject probably much better. And maybe that today in my almost 1 hour 30-minute session, which are till 6:30, if I have to take it, I wish that, okay, I take certain things with me and do more research to do what are the issues, and to the best of my understanding if I can address the issues on the subject which has been assigned to me. Now, may I ask that, okay, if you see, if I can make it interactive, if the others can also unmute, and if I ask the questions, they can answer that question, that would be of a great interest. Rather than listening, I know that, okay, any person who is listening to someone, probably after 30 minutes or 45 minutes, he will say, yaar, paas bahut ho gaya. No, it's very boring, right? But if we'll make it more interactive, I think we can have much of the advantage if we can take it. So I am free to ask the questions, and if you can really come out with whatever the out-of-box thinking you have, whatever the subject which we are discussing, I'll take my subjects, I'll take, I'll put my presentation also, but for the time being, let me just say, when I have been asked to give a session on compromise and arrangement, so the first thing which comes to me was that which are the provisions when we are talking about it's a corporate advisors and executives, and you all must have gone through the provisions of the Companies Act, right? So if you see that, okay, in the current Companies Act 2013, which are the sections which deal with this subject? Any idea? Anyone? No answer? No, let me just put it. It is section 230 to section 240 of the Companies Act, which deals with the subject of, it was as good as a section 390 to section 396A, and the court process was from section 391 to section 394A under the 1956 Act, which I would say, if I put it synonymously to this, is it is section 230 to 232, which the subject which we are discussing, it is through the NCLT process. Now, if you look at the heading of this chapter talks about compromise. This chapter talks about arrangement and amalgamation. Earlier it was saying it is compromise, arrangement, and reconstruction. Now, when I am discussing on this, another question coming to you, probably if you can unmute and can answer, what compromise presupposes? Anyone who can answer to this, that what compromise presupposes? Compromise हो रहा है तो क्यों हो रहा है? Is there any answer?
Sir, it is probably understanding between two or more parties, maybe creditors or shareholders or company. Some understanding.
Yeah. Anyone else?
It is it can be some settlement on the mutual consent of the two parties, maybe for anything. Like it may happen that a party is going to have going to acquire a company, but they are not acquiring; they are merging and having a compromise. Maybe, I don't know.
So I was just asking that the compromise हो रहा है तो क्यों हो रहा है? Then what presupposes? क्या था कि जिससे वजह से हमें compromise करना पड़ा?
There was a dispute basically.
Yes, this is what I am to. Compromise presupposes that there was a dispute. And believe me, I am telling you is that even if there is a dispute between the company and its shareholders, Even if there is a dispute between the company and its creditors and you are not getting answer under any other provisions of the Act, this is the chapter which comes to your rescue. In one of my articles, I had written that the corporate restructuring is a panacea of corporate turbulence. You know, panacea means to सब रोगों की एक दवा. You draw a scheme of arrangement, you get it approved with the requisite majority of the shareholders and creditors, and that is, you get it approved with the requisite majority of the each class of shareholder and each class of creditor. And once you got the scheme approved with the requisite majority from each class of shareholder and each class of creditor, it is even binding on the dissenting shareholders and creditors. Such a wonderful provision which has been given. So it's not only we are talking about the mergers or demergers only under the scheme. I've got the schemes approved of the compromise also as part of section 391, 394, which is now we are saying that it is 230 to 232. And the word arrangement is of a very, very wide connotation. It is not restricted only to the merger or demerger. Even if there is a reconstruction of share capital and you are not finding any provisions under this, you can work it out here. That can be worked out. That's the one provision I'm just making it this. Now, when I'm talking about that, under this section, so this entire chapter, if you see, it deals from section 230 to section 240 of the Companies Act 2013. And before I even make the presentation, I'll little bit dwell upon about those sections also, which are very, very relevant. And then I thought that, okay, I can share with you certain case studies. I can share with you the practical aspects of that so that you can have a knowledge of that. Before that, when I'm saying that the scheme is to be approved by each class of shareholder and each class of creditor, what is the kind of resolution you have to get it passed? Under section 230 to 232, let's say. Any idea? What is the kind of resolution we have to pass? Is it an ordinary resolution? Or is it a special resolution? Or there is something else? You can have two types of resolution. Special resolution or an ordinary resolution normally. But what is the distinction here? We have to look at it. Here the resolution, sometimes people say, no, it is a special resolution. What is special? There is no terminology under the Companies Act that there is a special resolution. The only thing is that there are two limbs of the definition. The one limb of the definition is that the resolution has to be passed by majority of the persons who are present in person or proxy, or now these days, you see, if the resolution through e-voting, then you have to calculate the e-voting or postal ballot concept under the 2013 Act has also been brought in. So you have to calculate the numbers. So the resolution has to be passed by a majority of the persons who are present in person or proxy or through e-voting or postal ballot. Take a pause here. It has to be passed by majority of the persons who are present in person or proxy or e-voting and doing the e-voting or doing the voting. Take a pause. Suppose there are 100 shareholders. Out of that 100 shareholders, 5 shareholders came, they marked their presentation, and thereafter they left. They had some refreshment and they said, you know, we are getting late, we will not be able to vote. And then the issue came that what do we need the majority? Whether the majority to be calculated out of 100 or the majority to be calculated for the 95. Because the law says that the persons who are present in person or proxy and voting, and then taking. And then is those who are present in person or proxy and voting, they must hold at least 3/4 of the value of those who are present in person or proxy and voting. That means majority has to be seen, and thereafter those who are voting, the 3/4 of those must have approved the resolution. And once that has been approved, then it is even binding on the dissenting shareholders and the creditors. And the meaning of dissenting shareholder has also been given. The dissenting shareholders does not only mean that who have voted as a no. No. Even those who could not vote, they have termed it as part of the dissenting shareholders. And there is a Supreme Court judgment in Acae Gupta case. They said once it is approved, it will be binding. So it's the scheme approved. That is why we normally called that it is a code in itself. The scheme passed under section 230 to 232 is a code in itself. Then we talk about it's a single window clearance. Why we are saying so? Even if you have the result in the scheme, you want the reduction of share capital has to be done. You can do it as a part of the scheme of arrangement. You need not to follow a separate process. You want shifting of the registered office from one place to another place. As part of the scheme of arrangement, you can do that. I've seen people converting the status from public to private or private to public as part of the scheme of arrangement. You can very well do. It's not that, okay, you have to follow a different process. You have to make a law for that. That is what we are talking about, is that it's a complete code. Then comes is how we have to pass the resolution. Normally, in a shareholders meeting, how the resolution is passed, we say by show of hands, or we are seeking postal ballot or a e-voting. And if the voting is demanded in the physical meeting, right? But here in this case, the resolution has to be passed by voting. There has to be a poll. It's not that poll has to be demanded. You cannot pass the resolution only by show of hands. That's the another aspect of this. Let me take you to the another aspect. When I'm talking to you, is that the resolution has to be passed by each class of shareholder, and the resolution has to be passed by each class of creditor. The question comes, what do you mean by class? Can I say that promoter shareholders are a separate class and the public shareholders are a separate class? Can I say that? Any yes, no? How many class of share capitals we have in the Companies Act? Any idea? So we have two classes of share capital. One is the equity, another is the preference share capital. And the equity is further divided. It's how equity with normal voting rights, the normal shares, or the equity with differential rights as to voting, dividend, or otherwise. And sometimes we debated, what do you mean by otherwise? So we have to determine the class. Then the issue came, how many class of creditors we have? Because we are saying the resolution has to be passed by each class of shareholder and each class of creditor. So the determination of class becomes very critical. I still remember in one of my case, idea was to get the resolution passed, get the scheme through. And in that company, there were unsecured debenture holders holding about 12 or 13% odd of the total debt. And the scheme, somehow they were demanding something more. And they said, no, we are a separate class. So can we say that there are secured creditors, there are trade creditors, there are unsecured debenture holders? Let's see. Can I say that unsecured debenture holders are a separate class, or other trade creditors who are also the unsecured creditors, they are a separate class? Or I can club it that, okay, no, there are only two classes of share capital creditors. One is the secured creditors, another is the unsecured creditors. And then I go through that. And then this matter came up. They said, no, we are a separate class. Now, if I determine those debenture holder as a separate class and they will not approve the scheme, my whole process, the entire scheme will go waste. I'll not be able to carry it through. So we argued on that matter, that there are only two classes of creditors. One is the secured creditor, and another is the unsecured creditors. The court said, yes, there are two classes of share capital. There are two classes of creditors. But it is also to be seen what kind of treatment you are giving to a set of shareholders or a creditor, though are falling within the same. Now I'll just give you the example. If I propose it in a scheme of arrangement, that as far as the public shareholders are concerned, they will be given the preference shares. But as far as the promoter shareholders are concerned, they will be given the equity shares. What I've done, I have created a class within the class. Now, the moment I've created a class within the class, they are right to say that we are a separate class of shareholders because the treatment which is being given to me is different. And on the contrary, if I say that there is no difference treatment, even to the trade creditors or debenture holders, the scheme is the same, they will say, yes, you club it. Now, the moment I clubbed it, they are only 12%. Even if they make a dissent, and I got 75% of those who are voting in person of proxy, my scheme is through. And the moment the scheme is through, it is binding even on the dissenting creditors. That's an important aspect, which one has to look at it from that angle. So chat is here, maybe. Okay. So that's a one part of that, which I am just looking at it as. Before I'll take you to some examples, I'll take you to the reasons why it is so. I thought that it is important for me that I can take you certain legal provisions which are applicable. And that is the important aspect which one has to see. So section 230 to section 232 are the sections for which you carry the scheme through the court process where the jurisdiction has been given to the NCLT. And you have to, if I broadly discuss with you, it's a two-step process. You have to draw a scheme, and if you are a listed company, you get the approval under LODR from the stock exchanges, which they in turn send it to the SEBI, and you get that approval, and the moment that approval is there, then you have to file a scheme. Now, when you have to file this scheme, you have to look at it from the aspect that first, it is a first motion application seeking convening of the meetings of the shareholders or creditors. Or you can seek dispensation of the meetings of the shareholders and creditors. Now, when this issue of dispensation came, earlier what was happening that, okay, if any creditor whose dues were there and there was little bit, even if it is hardly 0.01% of the total debt, they will go to the High Court and they will object to it, and then you are getting the notice issued to the others, and then at least 2-3 hearings, and then that time also there were the judgments that you cannot stall the process and you cannot take it as a suit for recovery. And that is why in this scheme we say that all assets and liabilities of the transfer company will become the assets and liabilities of the transfer company. All profits or losses of the transfer company becomes the profits or losses of the transfer company. That's the one part. But then when this amendment came, or the new statute 2013 Act came, they provided a provision that who can object to the scheme. And for objecting to the scheme, they said that if there are creditors, right? If the creditors owning more than 5% of the total debt, they can only object to the scheme. And the shareholders, if they are 10% or more, then they can only object to the scheme. So if you see the philosophy of the Companies Act, and this was one of the matter I was arguing it, that who can object to the scheme? And it was even 2013 Act. There is a judgment of Justice Sikri in one of my matters in Indrama Investment. That who can object? And at what stage they have to object? And he said that, okay, if you look at it, the company is to be governed by the board of directors, but the control is with the shareholders. And the law has given certain thresholds. The one threshold is the 90%. That is, if anyone having less than 10%, they can't go even for the operation mismanagement. Then there is a concept of a special resolution, 3/4. Then there is a concept of a ordinary resolution, that it is 50% plus 1 share. And then, so 10% limit, 50 plus 1 share over, that's a limit, 75%, 90%. And the law has very well recognized to that aspect. That if we approve the scheme, it is binding. They should not have a dissent to this. But somehow, if you see the provisions of the Companies Act, as regard dispensation is concerned, they did it only for the creditors, and there was no provision for the shareholders. And then again we went there, because you see earlier in Bombay bench, and they were saying, and there is contrary judgment even when Mr. Prakash Kumar was there, they said, no, we cannot, you have to hold the board meeting. I don't have any power. But the other benches, and at his time when he was not on the principal bench, the other principal bench member, Justice M.M. Kumar and all, they invoked the inherent jurisdiction, and they said that, okay, if you have the requisite approval, 100% shareholders are giving, or if it is a scheme, and it happened to that aspect, there are only 2 shareholders who are husband and wife. He said, you are saying that, okay, we are giving the consent. You are saying to hold the meeting, you will appoint the chairperson, alternate chairperson, and many people had withdrawn at that time even the schemes. But now, I think to some extent, I have seen the way the judgments are coming, that dispensation of the shareholders is equally good. They are invoking, though under the law, there is no specific, unlike for the creditors, that if you have got the consent of more than 95% the consent, then you can dispense with the share. Now that is the aspect which I'm just taking it as. The moment you got the order for convening the meetings or dispensation, if it is for convening the meetings, and I told you that you have to prepare yourself for conducting the poll process. You have to issue the notices, you have to chase it up with the chairpersons who have been appointed, you have to make the publications, all that. And when the meetings have been happened, you have to see that, okay, the requisite majority with the numbers that has been obtained, chairperson will file the report, and then comes to the second motion. And when the second motion comes, then the issue comes is you are filing the second motion that, okay, now the chairperson has given the report, we have followed the process, and it has been approved with the requisite majority of the shareholders and creditors. And now the Lordship may issue the notices. Even in the first motion application, you have to issue the notices, and now they are looking at it is otherwise the law is something different. Practice wise, we are again getting the issue. At the first motion itself, the notices are being issued. And to whom it is to be issued? One, notice has to be issued to the ROC, to the regional director, and if it is amalgamation, you have to issue the notice to the OL. Why OL? Because they say if the company is subject to winding up, and in the amalgamation, they say the transfer company shall be dissolved without the process of winding up. And that is why the notice had used to go to the, and in demerger, we sometimes say that, okay, the company is not subject to winding up. There is no need that, okay, you have to issue the notice to the official liquidator. That's the second aspect for that. So once the notices, and if you are a company which is subject to regulatory provisions, you have to issue the notice to the regulators. Suppose if you are a company which is an NBFC company, the notice has to go to the Reserve Bank of India. If you are a company in the insurance sector, you have to send the notice to the IRDA. If you are a company in the telecom sector, you have to send a notice to the TRAI. And if you are a company in the real estate sector, let's say, and your projects are going on, to whom the notice is to be issued? Let's say your registered office is in the state of Calcutta. Your project is being done in UP. Do I need to send a notice to RERA Calcutta or to RERA UP? So the notice has to be sent wherever the projects are being done. If it is in UP, you have to issue the notice to RERA. If they are also doing the project in, say, in Delhi, then RERA Delhi, or in Haryana, RERA Haryana. So the notices have to be issued. And otherwise the law is that they have to send the response within a period of 30 days. And there is also a provision that if they are not saying that, okay, it will be considered as a deemed consent, it's under the law. That is how the timelines are prescribed. But somehow, when we go for this issuance of second notice, we again say that, okay, the notice be issued to those. If they are not, because it invariably happens that they are not submitting their report on the first motion itself. They submit their report after the second motion and the process is going on. Otherwise, in the second motion, they say that, okay, if certain regulators or these authorities, they have made certain observations or objections, then on the second motion, the notice has to go. But we are complying with. Let that as it is. It may be that we are not going. Let the procedure follows. Then comes, and once you have to follow it up on the final date, whatever the objections or the report, OL report and other things, if it is clear, the courts normally approve it, and there are Supreme Court judgments that court cannot sit on the appellate jurisdiction. That you will examine it if the share, normally if the scheme is approved with the requisite majority, overwhelmingly by all the shareholders, creditors, and there are no objections, and OL has said that, okay, he don't find that, okay, it is against the public interest, or if there are certain objections raised by the regional director, you contest those objections, the matter is heard, and once that is there and they say they will reserve the order, and normally once a matter is reserved, they will pass the scheme. In exceptional cases, maybe that okay, but I have seen that in most of the cases that if arguments have been held, they have reserved the matter. 99.9% I would say the scheme is tend to be approved. That's the procedural part I was just looking at it. So I've gone through right now when I'm saying that 230 to 232. Then comes are the section 233. Now you till what time I have till 6:30? I have to be there now.
Yes, sir.
Okay. Any questions I can take it because so I'm not using my presentation, rather I would love to use. So let me complete it in another crisp 5-7 minutes, and then I'll go by my presentation on the case studies. I think that will be of interest to you too.
Sure, sir.
So let's come to section 233. That was a fast track merger. Why I'm saying that is in the presentation, but before that, I thought that okay, I can share my thoughts on the statutory provisions, which I can take it up with you. So 233 is a fast track where you need not to go through the NCLT process. What you need to go is that the fast track is applicable where it is a merger of a wholly owned subsidiary with the parent company. Or if there is a merger of small companies. And the definition of small companies has also been now, you see, modified, and invariably I will say that it's a very, very beneficial provisions. And now, or which was there or as may be prescribed by the government. Now the prescription has been done that even for startup companies, they have allowed the fast track. Either startup companies with another startup company or startup company with a small company, you can take the benefit of fast track merger. But broadly, I'll tell you, there is a catch, and we have to see. I've done the fast track schemes where I would encourage the professionals like us that they can really think about on the fast track process where two things are prerequisite. One is there is a declaration of solvency. So if the declaration the directors have to give, so in certain cases, if the declaration better, you move it under 230 to 232 rather than saying 233. And another important aspect, which I would say is, somebody was asking that there is a listed company and there is a wholly owned subsidiary, why not I should go for the fast track merger? I said, yes, you can go. But I only have one issue, that in a listed entity, you have to get the scheme approved by at least 90% of the value of the shareholders. And there is a judgment of the NCLT that value is to be considered of total value. As against 230 to 232, which I was saying to you, that it is 3/4 of the value of those who were present in person or proxy and voting. But here, this says that you have to take a total. There is NCLT judgment. So that becomes problematic. But for small companies where you can easily get the consent of 90% of the shareholders and the creditors, I think it's good that, okay, we can take it. provided we are meeting the criteria of such companies who are eligible to go under Section 233. Then is coming Section 234. Now this Section 234 is a cross-border merger. We had earlier also a cross-border merger under the 1956 Act, but that has been enlarged and there are conditions to it. One is that the cross-border merger, earlier what was happening, they were saying a foreign company can be merged with the Indian company, but Indian company cannot be merged with the foreign company. That was the position under 1956 Act. Why so? Because there in section, if I recall, section 393 explanation, they were saying that transfer company can be a body corporate, but the transfer company must be a company under the Companies Act. But that provision has gone. So we were saying that the foreign company is a body corporate, and I had the privilege of, you see, merging the foreign companies, two matters, with the Indian company. But that time Indian company was not there. Now under Section 234, they said Indian company can also be merged with the foreign company. But now they have put such caveats. One, that the approval of the Reserve Bank of India is required. That is one. And secondly, the foreign company must be into a notified jurisdiction. And that MC has issued a circular that, what do you mean by notified jurisdiction countries? Where the companies, they have a financial regulator or the companies are subject to FATF. Those are companies. Otherwise, if you look at the concept where we talk about the tax emanations, you have a company called Isle of Man, you have a company in BVI countries at a British Virgin Island, you have Mauritius, you have, so basically, but wherever in those countries now there is a regulator or they are subject to FATF, that is fine. But the companies like in BVI and all, maybe now, if any company, because I had a chance to merge the BVI company, let me tell you, into an Indian company, that was a very important aspect. Maybe that I'll share that there was an Indian company, multinational, having subsidiaries overseas, and they had the layer of subsidiaries, like the one subsidiary was in, say, Cyprus. They had a company, that company had in BVI, and it's a long time back, I'm telling you, is the matter almost, if I say about 15, 16 years over that also. And that company had a business in London. The London business was sold. Money eventually came to PVI. Now, if that money was to brought in India, that was subject to tax. But when we analyze the provisions under the Income Tax Act, there is a provision. And if then we thought with the consultation of all that why not merge the foreign company with the Indian company? And you see all the assets, that means the cash even lying becomes the assets of the transfer company, all assets and liabilities, no tax. So sometimes I say that, okay, this corporate restructuring is also one of the best tax planning tool, but now after the GAR has come, one has to be cautious that there are GAR implications unless until you have a very good rationale for these schemes. So must take care of the provisions of the CAR and take into confidence. That's the one part. Then comes section 235, which probably I would say it's like a takeover section, where if you have acquired the shares of the other shareholders by more than 90%, and within 4 months, you are seeking to acquire the shares from the remaining shareholders, then the law has given you the right to the majority shareholders to compel them to sell their shares at a price which was given in the scheme. That's under 235, there is a process. And section 238 is linked with section 235. No, earlier that was not there, because earlier also you had to file it, but that was coming through the rules. So there was no substantive section. So they added section 238 linked to section 235. Now the two things which are coming out of section 235, very important, which I can discuss with you, is the one important provision is where we are talking about is that when you acquire the shares, so it presupposes that 235 is applicable only in the matter of transfer of shares. And then it gives a right to the majority shareholders. So there was only a right, not an obligation. Suppose a person who has acquired the shares, say a 92% or 93%. This is why we should spend more money. Let the 7% shareholder continue to be there. What will they do? They can't even go to the NCLT for operation mismanagement. Rest we will manage. Why should we spend? So these were the discussions. Then the legislature in its wisdom thought, no, there should be a minority protection. And then 236 was brought in on the section of minority protection. In 236, no, it is not restricted only to the transfer of shares, but of every kind. If you are acquiring the shares by contractual arrangement, if you are acquiring the shares by way of merger or amalgamation or otherwise, and if you acquired more than 90% shares, now you have to have that offer you have to give. And now the minority
Sir, you are on mute.
Now I'm saying that 236 gives right to the minority shareholders. So majority shareholders have to put that money, but there is only one important aspect is now here the valuation has to be done by the registered valuer. Unlike in 235, the value is that what value you had given under that offer letter for acquisition at that price. Now here it's that the valuation is to be determined. You deposit the money, and now in 1 year, if these minority shareholders are there, they will have a right either to dispose it or not to dispose it. Then comes section 237, which we called about amalgamation in public interest. And that is where amalgamation in public interest we talk about. Here you need not to go to the NCLT process. It is the ministry who, by way of notification, approve the amalgamation. that it is in the public interest. Like I'll give you the example that we had Indian Airlines got merged with the Air India. A new company was formed, notification was issued, and the merger took place. And there are certain other examples too, where the government has issued notification. 238 I've already talked about. 239 is the preservation of books of accounts. Now, normally we say that you can keep your books of accounts for a period of 8 years under the law. But here you have to read that provision with section 239, which talks that if there are any books of accounts which are pertaining to the company which was subject to amalgamation, you cannot dispose it of without the permission of the central government. So you have to be very careful in that. And then comes section 240. So section 240 is also a clarificatory section otherwise. But they made it clear that notwithstanding that, okay, that on the merger, a transfer company is getting dissolved in the process of amalgamation. That means that the officers in default, who were the officer in default in the transfer company, they will continue to be liable. पहले क्या होता था कि यदि कोर्ट में मैटर गया हुआ है, they will go that okay, the lordship, there is already a merger. Now since the company has gone, my liability has also gone. There is no. And taking a cue, I had a very good argument which I took it. Justice M.M. Kumar even recorded in that order. Long time back. That where the RD made the objection that there was a loans and advances for about 20 lakhs. And as per the accounting standard, you have to give the nature of the loan. You have to put it in the, and they had not given the nature of loan because the amount was very, very minuscule. And he said that, okay, no, you have to revise or you have to get that compounding done. Now I filed the compounding application, and next date of hearing was after about 5-7 days. My compounding application, now the matter was if the compounding application is pending before the RD, can the NCLT approve the merger? And I argue that matter. I said, see this section. In this section, because of this, there is no penalty prosecution on the company itself. It is only on the officers in default. And the section 240 talks about it. And they said, yes, fine. He approved the amalgamation. And we got the compounding at a later stage because it was an independent action. So I thought that, okay, this span I can just briefly touch upon certain regulatory provisions which are very, very relevant, which any professional who is undertaking the process, he must be aware of that. Though I will now take you to the certain practical examples and the tax provisions which we can just talk about. But one thing which is coming in my mind is that as and when you are involved into any aspect of corporate restructuring, the one thing I'll just advise you that यदि आप सुबह सुबह राम राम अल्लाह को याद करते हो, जीसस को याद करते हो, वाहिगुरु को याद करते हो, आपने एक काम करना है. आपने कहना है stamp duty, stamp duty, stamp duty. Believe me, I'm telling you, don't take it as a joke. I have seen companies withdrawing these applications because of stamp duty applications. I still remember it was in 2000, early 2011, actual judgment came and someone came to me that, okay, just this thing, I said, okay, just examine the stamp duty because you have the financial advisors, they are advising you. I don't have any problem. But better that, okay, so my conscience is saying that, okay, you get the implications examined, and it was one of the big groups having this stamp duty. I would say the plants almost in spread over 7-8 states. And then they came to me after about 15 days stating, Satvinder, we need to withdraw. What happened? No, my financial advisor has said now that there is a potential implication of about 108 crores. That is now your call whether you want to take a risk or not. And they said, no, we don't want to take a risk. And believe me, today we are fighting the matters before Delhi High Court on the stamp duty, because that is another subject which is core to my heart apart from the corporate restructuring and IBC, and which I normally take, and many of my students, and I take privilege that they are partners in big fours and all, but it's one of the subject, stamp duty, corporate restructuring, and now you see tomorrow I have to take it, the corporate restructuring, the mergers vis-a-vis IBC. In one of the subjects they are saying, probably I have to think on that, and maybe that the ICICI program in the certificate course, they have asked me a few days before. I'll take it in a different way. But I'm just making it as, please look into and take care of the stamp duty. Kabhi mauka milega, so then we will discuss on the stamp duty part separately. That itself is a subject which one can really think about. Now, I welcome Rahul also. Is that I am okay. So any question till now, probably I can take it up and then another 20-25 minutes, because we have another speaker and we would love to hear him also. And any question right now, if I can answer, and then we can take it. Because if
anybody has any question, so sir can probably either they can write in the chat box.
Okay, I'll what I'll do is let me just quickly wrap up my presentation. Rahul, I think I'm supposed to speak till 6:30.
Yes, sir.
Okay. So you never know, because the problem is with the lawyers. The only thing is they will ask that, okay, the Lordship, I only want 1 minute to address. And when this 1 minute becomes 1 hour, right? And you can continue. But let's come to the need for corporate restructuring. As I said that, okay, I need not to develop bond, opening up tax planning tool, foreign investment. You are talking about the backdoor listing. That's another subject which one can take it. But one important aspect I would like to take it up is family settlement. Believe me, don't think that, okay, this subject of corporate restructuring or compromise or arrangement is of a matter of big groups. I've seen even a middle class companies, the mid segment, in the MSME categories. They have grown, two brothers, their kids have grown, and are invariably sometimes becoming a mediator, settling the issues, and one will say, no, then the issue comes how to divide the assets of the company. And then we start thinking about the demerger. And everything which, so everything which I have to do is to see that whatever the scheme I am proposing, it must be a tax efficient in nature, right? So you need to bring the tax efficiency in that. So, but if you say that my scheme is only for gaining the tax advantages, because there are tax advantages, right? You need to have the carry forward of losses, and today the losses, any business losses has a value. Otherwise, in a period of 8 years, those losses will be lapsed, and you want those losses to be revived further. And you feel that, okay, on the one side, I have another company which is a profit-making company, and there is another company which is a loss-making company, and it is falling within that section 72A of the Income Tax Act, and it comply, and you think that, okay, there are reasons, you merge that company, and that those losses will be revived for another period of 8 years from the date of amalgamation. That's a big advantage, which you can take it up. But it is not that every scheme is only meant to take the tax and cost advantages. Those should be incidental. But people are looking at strategic synergies, which you talk about: growth in market share, diversification, global platform, market penetration, enhancement of technical know. I was involved into the one technical collaboration agreement of one of the group who were making car mirrors, and I was amazed that there is a separate technical collaboration for the front end mirror and the rear end mirror. And when we talk about the structuring about it, is both in case of demerger, which I will just take you through little bit on that. But if you see the various forms of corporate restructuring, you're talking about the acquisitions by way of share purchase, you're talking about the sale of assets, simpliciter, or asset purchase as a slum sale or itemized sale, or if you're talking about a merger, you're talking about a reverse merger or a forward merger. You're talking about demerger, or you are thinking about the capital reduction and buyback. This is what I can envisage. I thought that, okay, I can take it. And these are the restructuring options and objectives which we are talking about. That you need consolidation. You are thinking about a tax planning. You are looking for exit or dilution mechanism by way of selective reduction. And that's where you can easily give an exit to the minority shareholders, which we did it, and probably we are doing it. Buyback of shares, right shares, dividend, merger, how you can do the cash repatriations, all are the options which we discuss it. So the first question, as I was saying, that what is merger? What is merger? No, if you look at it, is it visible, Rahul?
Yes, sir. Yes, sir. It is visible.
No, if you look at it, let's say that the company A will
हम आपको नाम और इसमें भेज दें WhatsApp. दो.
Yeah, company A will get merged with company B.
नहीं.
And the company B will issue shares to whom, or issue consideration. That's the important aspect. I've used the word consideration, not the shares. Company B will issue consideration to the shareholders of company A, which is a transfer company. All assets, all abilities, all rights, all obligations, contracts, employees, everything goes in company B. What remain in company A? Company A will become shell. If it becomes shell, it is a hollow. So law says that the transfer company will be dissolved without the process of winding up. But here I'm just taking you when I'm saying the consideration, you must also look at the provisions of accounting standards. If you are an Ind AS company, then probably you have to adhere to Ind AS 103. If it is non-Ind AS, then probably AS 14. And if you see, there are two kinds of methods which were given in Ind AS 14. In AS 14, one is the pooling of interest method, another is the purchase method. In pooling of interest method, if you go through, they said that you have to issue equity shares. But in purchase method, they said you have to issue consideration. Then you can issue. But then you have to look at the income tax provisions also, where this says that you have to issue shares to make the scheme tax effective. Then the question comes, can we issue preference shares to the equity shareholders of the transfer company here in company A? You have to look at it whether you are coming under the pooling of interest method under AS 14 or a purchase method. If it is the purchase method, you can issue preference shares because under AS 14, but under Ind AS, probably even that restriction has gone, subject to verification by the your statutory auditors and accounting. I am not a chartered accountant, but I'm just making it is because of my experience. I'm sharing this thing to you, and we can take that. Now, if you look at the provisions under the Income Tax Act, this is section 21B, where you say that all the properties of the amalgamating company, all the liabilities of the amalgamating company, the shareholding holding not less than 3/4 in the value, they will become the shareholders. The word is only the shareholders. Even the preference shareholders also the shareholders. And then you have to look at the provisions of section 47. Let me take you one case study on the merger. Suppose objective is to consolidate similar business within the group companies to reduce operating costs, pooling of resources, avail carry forward of losses. And I have a company ABC and DEF, where these two companies were the loss making and merged it. And eventually what happened? I took the benefit of the losses in the profit making company subject to GAR, but yes, consolidation, you have to give the rationale. And then this is the resultant structure which will come. In the reverse merger also, the process remains the same. There is nothing as far as the process is. You can have that here, shareholder, profit-making company, loss-making, reverse merger, it's only a terminology. You can say the profit-making company is getting merged with the loss-making company. You can say that it's a holding company getting merged with the subsidiary. Like there was a company at one point of time, I'll just give you ICICI. ICICI got merged with the ICICI Bank. Both are profit-making company. They say no, it's a reverse merger. So it's only a terminology. Process is the same. And largely when we were dealing in SICA, and that is where you had to preserve those losses and all that, the concept of reverse merger work came. So suppose there is a company which is a loss-making company, but transferring a loss-making company into a profit-making company may not work because it will not comply with 72A. It's better that, okay, we can think about merging the profit-making company in a loss-making so that at least for, if it is, the losses are not immediately being lapsed, you can take that advantage. And now there is another important advantage which people are thinking about is where there are acquisitions under the IBC. It's a separate process. We can take it, but I'm telling you, acquisition through IBC process, people are taking it as where there is a loss-making companies and all that. I don't know, but that's another way which one has to see. Reverse merger, I have taken it. Then comes to demerger. Again, in the demerger, only part of the undertaking. Undertaking, suppose a company A, it is into the cement business and textile business. One of the undertaking is going to company B. Let's say it was part of the family settlement. So one brother said, okay, you give me textile business. Another brother, it's a settlement, but how we can divide the assets? So we set up a company B with the promoters. It's a mirror image. They are brothers, related parties. The textile business got merged in company B. Company B has issued shares to the shareholders of company A, where both the family members were the shareholders. So there is a mirror image now of company A, which has a cement business, mirror image of company B having a textile business, and they swap the shares, the gift without tax. And you see this without any cash involvement, without any things, without any taxation, there is a settlement through the process of demerger. So these are the definitions which have been given. I'm just skipping it. Consolidation of business, again, where you need to consolidate. That's another example which we did it. A company which was into FMCG, which was into real estate. And again, part of it was through the family settlement and other things. And the discussion that, okay, real estate should go. And it was decided. And we took that example. Real estate has gone. Shares were issued. And it's all gone. Then is the slum sale. So I'm just making it is that both in case of demerger and in slum sale, what is being transferred is not merely the asset. What is being transferred is the undertaking. And then the question comes, what do you mean by undertaking? And there is a Supreme Court judgment also of the Rustamji Kabirji, which normally we say that the R.C. Cooper case. And if I put that wording in a simplistic way, they said the undertaking means it's a business unit which is engaged in a gainful occupation. But it is distinct from the assets and liabilities it comprises. So if I say that, okay, this is the whole, it's the undertaking, this undertaking involves movable assets, this undertaking involves immovable assets, long-term liabilities, short-term liabilities. I'm not transferring the individual assets. What I'm transferring is the undertaking as a whole. Bombay High Court in Lee Taka matter, they said that though undertaking involves immovable property, but for the purposes of stamp duty, it is a movable asset. Because you know that the stamp duty for movable asset is different than the stamp duty for the immovable assets. That's another way of looking at it. Without assigning values to the individual assets and liabilities, the assets can be of say a 450 crores, your liabilities maybe you're going to 470, it's a negative net worth. And you transfer the assets. And I have, in one of the matters, I was told, no, it doesn't, but I've gone through that, where the stamp authority said that, okay, you have to pay the stamp duty on 450 crores. He said, no, what I've transferred is the undertaking, not the individual assets. You cannot have the presumptive value assigned. And you end up paying a stamp duty on 5 crores. I'm just giving you the example. So that's a slum sale. One important aspect I would say that I'm very happy when I cracked it was the inbound merger, when foreign company was to be merged. And I'll just give you the example of where, look at this structure, the company in Hong Kong. The promoters were earlier residents of Hong Kong. They shifted back. They have a listed entity here. And that company, where those family in company XYZ is holding about 45%, 100% company ZFB, which is holding, their family is holding 100% with 55%. So that's the group shareholding. The immovable property, which was of a value, and today after that China fiasco and other things, they were saying to sell that property, but because of the issues, they couldn't sell it. So we thought that, okay, let that immovable property be parked in company ZFB, right? And in consideration, ZFB issued the debentures as a consideration. So asset immovable property becomes the asset of company ZFB, and the debentures become the property of XYZ. And they set up a company DEFE. And if you see this, DEF was XYZ was holding shares of the listed entity, which has a good value. So we thought that, okay, why not merge XYZ in Hong Kong with the Indian company DEF. So all assets and liabilities of XYZ will become assets and liability of DEF. So what will happen? That the moment you have merged, those shares of the listed entity becomes, so intent was to bring that share because that carry a huge value. So in consideration, so what happens that the assets, that the debentures in my books becomes the debenture holders of DEF, and DEF in consideration of amalgamation is issuing shares to the shareholders of transfer company, which is ZFB and the Maheshwari family. So we issued the, so cashless, I'm saying that one side is the preference shares issue. So there is a liability of DEF. On the contrary, there is an asset where the debentures company ZFB has to realize, and with subject to RBI permissions and the regulatory, you can really square it off the things. So these are the examples which I am giving you. I think I'll not be able to complete the entire presentation of merger, demerger, slum sale. There are issues which I've already discussed. What do you mean by appointed date, effective date? Those are the issues. Probably if I can continue, I can continue for another 1 hour. So there are issues which probably are there. And then is the, what all is to be seen by the stock exchanges, and then I've given the presentation, it was there. But since I've already completed, but next 2-3 minutes, 4 minutes, 5 minutes, because Gaurav is here, he has to also make his presentation. And with this, looking at the time constraints, I hope that whatever the time assigned, I'm able to justify it. And thank you once again. If any questions, Rahul, I can take up those questions from the participants.
Yes, I would request participants, they can directly unmute themselves and ask the question. That will be better, I think, because if we have the facility, so why not to use it? So if anybody has any question or whatsoever, so they can just unmute themselves. Otherwise, I think, sir, you have covered almost all the topics in the short point of time to just give a brief idea about what basically this compromise and arrangement is all about.
राहुल, दो ही चीजें होती हैं, या तो मैं सोचूं कि पार्टिसिपेंट ने सब कुछ समझ लिया है, या मैं समझूं उनको समझ ही नहीं आई। ये सब्जेक्ट ऐसा है। ठीक है?
ऐसा समझ में नहीं आने वाला तो बात है नहीं, because sir, when you are on the other side,
so this is a subject, definitely a subject of great interest, and we as a professionals, I feel it's where when we can take it up, it gives lot of eternal satisfaction also when we deal and this. Thank you so much.
Thank you so much, sir. So I, on behalf of the ACA, would like to propose a formal vote of thanks to you, sir. So you made the contribution to this particular corporate law conclave, Companies Act particularly, and the deliberation on compromise and arrangement. So that is quite a different subject, and I think it covers almost everything. So many aspects are there in this particular compromise and arrangement. So many ifs and buts, question and answers are many. Doubtless things. So it requires a much of a time, and I don't think that 1.5 hours will give justice. And when you are as a resource person there, so this was the least time which we could give, sir. So thanks once again, sir, for giving us this wonderful and enlightening session. With this warm words, sir, I would like now request Gaurav Bhai to take over. We have a e-memento as well, sir. So that I will share you over the email. So we share an email.
Thank you.
Thank you, sir. Thank you so much. Thank you so much for.
Thank you so much. Thank you, Gaurav. Thank you. Bye.
Thank you, sir. It was nice listening to you. I had attended a lecture in Pune a few months back.
Yes. So in 2 minutes, Gaurav Bhai will start just in 2 minutes.
Sure.
So that the participants. So by the time I think I should introduce our next speaker. So now I have an opportunity to introduce next speaker and my good friend and my elder brother, CS Gaurav Pingle. He is an associate member of Institute of Company Secretariat of India and has completed Masters in Commerce. And Gaurav brings in 12 plus years of practice and industry experience advising on business setup in India. Core company law matters from day-to-day compliance to advisory, transaction advisory, FEMA laws, SEBI listing regulations, securities laws for domestic, multinational and limited companies. CS Gaurav has authored books on securities law, virtual meetings, under the Companies Act, Related Party Transaction, Companies Amendment Act 2017, which were well received by the readers. As an avid researcher, he religiously authors articles and dedicated columns on the current case laws, latest happenings in corporate laws, and articulates his views, which are published in leading professional and business journals. In employment experience, he had led a team to set up a corporate law portal that provides real-time updates and analysis of company law, securities law, FEMA, competition law, and IP law. He was also associated with a Bangalore-based company as a domain expert in enhancing and improving corporate compliance solutions. So having a flair in teaching, Mr. Gaurav has been the visiting faculty for company law and investment and security at ILS Law College, Pune for 4 years till now. He was also visiting faculty at various colleges in Bangalore and Udupi. He has been invited to participate and address many conferences, seminar, workshops, study circle meetings, training, workshop conducted by ICSI, ICAI, management colleges and law colleges. So that was a brief what I could just give. I have skipped 2-3 paragraphs so that just I think Gaurav Bhai will give me an exemption for that, for leaving that. So now not wasting much of a time, being the interesting topic, managerial remuneration and with respect to the managerial appointment. So I will now directly hand over to Gaurav Bhai for taking the stage.
Yeah, great. Thank you, Rahulji, for the invitation as well as for the introduction. It is great to be on this platform where so many senior people and the luminaries were part of this for the last 62 years. It was great to listen to Satwinder sir also because I had attended his lectures few years back as well as a few months back in Pune in a one-to-one session. I somehow I'm not so very comfortable with online sessions, but yeah, I feel that we can interact more and we can reach out to more people through online. So this online is also quite interesting. I'm not feeling a bit well, but a bit of cough, not COVID. So I may drink water in between. But yeah, so I just would like to first appreciate the members present because it's a Friday evening. It's already monsoon season where it would have been
Friday evening and evening with filing of IT returns. So
yeah.
it is a Friday, so
Yeah.
31st. I don't think that ministry is going to extend the timeline. So that
Yeah.
is a little thing. So which is a reason for a less attendance.
No, that's not a problem, but I appreciate because practically all the 27 participants are not going to get any credit hours, but they are
Yes.
come here for exclusively knowledge, you can say knowledge sharing and knowledge participation. So I would like to appreciate the presence of all. And let's start with the session. I will share my PPT, but just before going into you can say the formal slides and all, I would like to state that these 2 points or these 2 topics which I'm taking, which is managerial appointment and managerial remuneration, are quite interesting and have been quite a few times amended also in the Companies Act, either by the Amendment Act or by the notification for private companies. So these 2 topics or these 2 subtopics are important for private companies as well as public companies, listed companies as well. Now, from what I could understand is that there are members of this institute who are chartered accountants, company secretaries, lawyers, cost accountants, and other professionals also. So I'm trying to balance my presentation so that it becomes equal for all the participants and it doesn't become uninteresting to any of the participants. So I'll just share my screen so that we can start with the PPT. Yeah, I hope it is visible now.
It is coming. It is just loading, I think.
Yeah.
Yes, now it is visible.
Yeah, if there is any technical issue, you can let me know so that I may, just in case I have to switch or stop my video or something like that.
No,
so
that's
that,
perfectly all right.
okay. Great. So this would be probably some 20th time that I would be presenting on this topic. And every time I present on this topic, I learn something new from this. Either it could be in a form of a notification, or it could be in a form of a judgment, or it could be in a form of an article that I've read, or it could be something that has happened in the corporate world, like remuneration of a particular director is not approved, or maybe it has gone for a revoting, or there is RPT which is there, or there is proxy firms that have given a different opinion. So all these aspects are there. So these are 2 important points for us. Typically for company secretaries, why this is important is because we are practically deciding the appointment and remuneration of the people who have appointed us in the company. So it is you are at stake as a employee company secretary, as a consultant also you are at stake because the people who have appointed you in the company as either as consultant, company secretary, or a CEO, CFO, we have to determine their remuneration and appointment in accordance with the Companies Act. Yeah, so broadly what I would like to discuss is 3 points. Even the point we have managerial appointment and remuneration, I would be first discussing the KMP related provisions because that is one of the source through which the appointments become mandatory. I will be discussing the MCA notifications as well. Any question from any participant at any point of time is most welcome. From a chartered accountant perspective, from a statutory auditor perspective, now under CARO, there is a mandatory requirement that they report even on the remuneration. that remuneration is paid in accordance with the provisions. As a company secretary in practice, we have to state that in MR8, MGT 7, MGT 8, that the appointment of managerial person has been made. So when you certify that, that time there are many checkpoints to that, and we need to be updated on that front. So therefore, this you can say a refresher course or a refresher session for the participants. It may happen that you may have a different experience on this. You can share that, or you can put it in the form of a post or a query. So we'll discuss KMP, then we go to section 196, and then we go to section 197. So we discuss KMP. This is defined in section 203. So every class of company should have a whole time KMP. That's an important aspect to it. So we have the MD, CEO, manager, and in their absence, we have the whole time director. So the whole time director is the last option which we have for the KMP, right? So we need to have a MD, CEO, or a manager. We'll come to these as well, the managing director, CEO, because what is there in the law, what is there in practice, and what is there in the judgments. One important point, or one important very recent adjudicating order which was there was that of a managing director. There was a penalty levied by the ROC. I don't remember which ROC, but I can share the order. But the issue was that the company had appointed a managing director.
So that was circulated in the WhatsApp, I think, recently.
Yeah. Right.
Largely circulated in the WhatsApp, that particular.
Yeah. So he was directly appointed as a managing director. He was not appointed as a director, additional director, or some other type of director, and directly appointed. So that was questioned by the ROC. So, these are so many minor things. Now, this is just one thing, like practically what should be on the letterhead, or how the director should sign, what should be there when they sign. So all those are so many. We sometimes think these are so many administrative things, but these are so important things when it comes to the submission of documents to the government. In fact, I also got one update that one company was incorporating another company, and they had submitted the resolution. In the resolution, or on the letterhead of the resolution, there were some things which were not adequate. So the ROC initiated adjudication. So see, it's like they are going for an incorporation of an entity, and other than incorporation, the proceedings of adjudication are being started. So what I'm trying to say is that how the importance of corporate law compliance is also increasing day by day, right? We are practically getting orders on a day-to-day basis where such things are there. Now, whether those are right, wrong, adequate penalty, inadequate penalty, that is another thing, because it may go into appeal and all. But the point that I'm stressing is that these things are started taking place. This was not the case 2 months back. This was not the case in 1956 Act. So it has become, we have to take it quite seriously, the compliances. Okay. So we have the first part, which we discussed. Second is we need to have a company secretary, and we need to have a CFO. Now, managing director has been defined. Who is a managing director and what powers he has. CEO has also been defined, but not adequately. Manager is also defined, but not, we can say, similar to that of a managing director. And whole-time director, we will be discussing the whole-time director as well. Company secretary means company secretary as a member of ICSI. And CFO is, interestingly, there is no qualification to CEO and CFO. So it may happen that a CFO could be an accounts officer for the last 20 years. He can also be the CFO. There is no minimum qualification given to the CFO. Same thing for the CEO. But the specific appointment needs to be made as a team. Now, when does this trigger? So for any listed company, it triggers on the day one when it becomes a listed entity. And any public company having a paid up capital of 10 crores or more. So this 10 crores or more, this paid up share capital, so it includes So this includes paid up, that is equity plus preference. And this includes at any point of time. There is no time limit like, like at the 31st March or 31st December. Anytime during the year the capital increases, the company has to appoint a K. And private companies, they have to appoint a company secretary. So this probably everybody is aware of. Now, what is whole time was the issue under Companies Act 1956, because whole time director was not defined, though it has been defined now, but whole time director was not defined then. Therefore, this issue we had. So we have a Bombay Court judgment of the in the case of Ramaben Thanawala versus Jyoti Limited, where they had tried to define who is a whole-time director. So whole-time director must refer to a director who spends his whole time in the management of the company in the sense as the MD does. So this is broadly what is the whole time. Why this whole time needs to be discussed? Because we need to apply this to the KMP. We need to apply this to the respective person which are there. So whole-time director, though, has been there through a judgment in the earlier part, but we now have a whole-time director definition as well. So we'll come to that. But this is the judgment which becomes relevant when we come to the KMP aspect of it. Now, managing director is a director. He may be appointed. I will not go into the very basics of it, but most importantly, he has a substantial powers of the management of the company. He either has whole or substantial powers. This is a very important aspect. Now, where does he get the substantial powers from? So it may be either through the board resolution, it could be through an appointment letter, it could be shareholders resolution, it could be articles of association, or it could be an agreement through which the managing director would be getting the substantial powers. Now, substantial powers have also been defined, but they have been defined in a different manner, as in what does not include substantial powers. So signing of checks and all that is not substantial powers. So strategic decisions of a company broadly will be considered as a substantial power. Now, why all this becomes relevant is because it may happen that a person is a CEO of a company or a person is a whole-time director of a company, but they have got substantial powers. So then it could be that those persons will be deemed to be the managing director, because the last part of the definition says that includes a director occupying the position of MD by whatever name called. We have manager also in the same way, but that also includes the, you can say by and large the same definition. Now we come to whole-time director. Whole-time director is a director who is in the whole-time employment of the company. Now this is something which we come across for our client companies and our own companies on a regular basis. Like you have got an employee, he gets promoted in the company, he becomes a director. For all compliance purposes, he becomes a full-time director in the company. So section 196 needs to be compliant if it is a private company or a public company. And when it comes to a public company, we need to check his remuneration that is paid to. CEO means an officer and CFO means a person. Now, I don't know how these definitions will help you, but that is how they have been defined. And company secretary is there. Now, anytime that you have thought of that whether the company has a executive directors, any idea that whether executive directors have been defined in the Companies Act? That do we have a concept of executive director, or it's just that it's a part of our academic part or a practical part or a corporate you can say corporate life where we have a concept of an executive director. Business parlance we use executive director. So executive directors, there are provisions under this Companies Act in 2013 where so it has been defined in one of the rules which says that executive directors means an whole-time director under section 2 subsection 94. So we need to refer this, whatever are the provisions for full-time director applies to the executive directors, right? So it can also be applied to some extent over here as well under the provisions of KMP. So it may happen that a company has a executive director a company secretary, and a CFO. So that could be the compliance under section 203. Okay. Now we come to section 196. Yeah. Yeah, so there is a provision under the law where you can't appoint a person below the age of the 21 as a managing director, full-time director, or manager of a company, or a person who is more than 70 years. If at all he is less than 21, then he can never be appointed as the managerial personnel in the company. But if he is more than 70, he can be appointed with the approval of the shareholders by passing a special resolution. So 70 is allowed, 20 or below, more than 70 is allowed, less than 21 is not allowed. Okay. But now the question is that when do you count this 70? Okay. I'll come to the particular case law, but the issue over here was that we had Companies Act and this section notified on 1st of April 2020, 2014. Now, somewhere in the month of October 2014, one of the directors in a public company, public listed company, managing director, he completed his 70 years. And that was on October 2014, somewhere in the month of October 2014. But he was already appointed in the Companies Act 1956 for a period of 5 years. Now the issue before the who challenged the appointment was his own younger brother. The younger brother wanted to be the managing director of the company. Therefore, he said that my elder brother has earned a disqualification on his 70th birthday, and therefore he is no more a managing director of the company. So he ceases to be because the company has not obtained the approval of the shareholders by special resolution. So what I'm trying to say is that the question over here is, when does the clock starts for counting 70 years? Whether it starts on 1st of April 2014 or whether it starts when he crosses the age of 70. So the Bombay High Court single judge observed, that is Justice G.S. Patel observed, that the director had a disqualification on first, the director didn't have a disqualification. He continued. The provisions are, you can say, they are not retrospective in nature. And whenever there is a fresh appointment under the Companies Act, that time he will be, you can say, considered for this. But when it went to the appeal, the division bench observed that the 70-year triggers on 1st of April 2014. That is when the law is applicable and not retrospect and not prospectively, and therefore any appointment that is to be done within the prescribed time. So this is some, you can say, broadly a summary of the particular judgment. So this is the first part is the single judge part, where he says that it doesn't interrupt the appointment. So any appointment made henceforth will be applicable. Then we come to the next part where it went to the division bench. Division bench says that the intention is very clear. It applies from the day from when it is notified, and then the disqualification triggers on that day. Now you will ask that why all this is being discussed now, because the case is of 2014. The reason that is there that I'm discussing is because it can happen even today. And interestingly, this judgment becomes relevant when we have the SEBI regulations as well. Now, SEBI has introduced a criteria for non-executive directors for the age of 75. Okay, so it applies to the independent as well as non-independent directors. But the question is, when does it start? Therefore, this judgment has a very, you can say, long duration for its application, and therefore this is the important part. I'll just quickly take a question because it has been asked by Mr. Ajit Tulsianji. He says whether a person can be appointed as a whole-time director in more than one company and can draw the remuneration from each company. I feel that is not a problem per se. Uh, if it is if he is being appointed in private companies, then yeah, he can be appointed in two or three companies. But if it is a public company or a listed company, then there is a provision under Schedule 5 about the appointment in the public companies, not listed public companies. And if it is a listed company, there is a provision for the directorships under the SEBI LODR. But if it is a plain private company, then he can be a director in more than one company as well. Yeah, and he also can draw a remuneration. Yeah. Yeah, this was the point that I was referring to. It says no listed entity shall appoint a person or continue the directorship of any person as a non-executive director who has attained the age of 75 unless a special resolution is passed. Now, why I'm emphasizing over here is when it says unless a special resolution is passed, it means that the special resolution is a prerequisite for the appointment beyond the age of 75 years. So if your director is 74 today and he is going to be 75 in the next 6 months, then it is always desirable to pass a resolution before he, you can say, before he becomes 75 by age at that point of time. So it is not a post facto, or it is not a, you can say, you can take an approval at any point of time. You need to be very cautious about this. Similarly, the provisions with respect to the managing director, manager, and a full-time director applies over here. No company shall appoint or continue the employment of. This is very important. Here it says employment. There it says about the LODR. It says about no listed company shall continue the directorship of. Now it's very obvious. The reason is because employment you will only use for the full-time employee, and here you directorship you will use it for the non-executive director. So this is a very important part. In fact, I authored an article on this aspect on India Corp Law, and I had it was a peak time when this provisions was introduced, and that time I had received quite a few queries of few listed entities on this matter, because I think so there was hardly a period of 3 to 4 months for giving effect to this change. Yeah, so to give a particular, to talk in a very section, or to talk about section specifically, section 196 has got 5 subsections. Okay, there is a notification dated 5th of June 2015, and by that notification, the provisions of section 196 subsection 1, 2, and 3 are only applicable to the private company. Right now, whatever is there in subsection 4 and subsection 5 is not applicable to the private company, but entire section 196 applies to a public company, a listed entity obviously, and a private company which is a subsidiary of a public company. Okay, I hope this is clear. Whatever we have discussed till now, 70 years, applies to the private companies as well. Okay, now we come to this schedule 5, right? Entire provisions of section 196, the reference of schedule 5 is here in subsection 4, right? Now if you see schedule 5 is divided into 2 parts. First part relates to the appointment, second part relates to the remuneration, right? First part, which is of appointments, so first part, which is of appointments, is applicable in my view only to public companies and not to private entities, because the reference of schedule 5 is there in subsection 4, and subsection 4 is not applicable to private companies. Okay, interestingly, in subsection 4 there is a reference which says that the appointment of the board of directors subject to the approval of the shareholders in the next general meeting And if there is any variance, then you need to report it in MR1 or MR2, whatever is the case. Now, nothing applies whatever is on the screen to private companies. Okay. So practically, if the articles are silent in the case of a private company, managing director, full-time director, manager can be appointed by the board of directors also. But if there is an explicit provision under the articles, then you need the shareholders approval. In my view, in case of a private company, you need not take the approval of shareholders if the articles are silent at the point. Okay. Now, MR1 is a form which is a return to be filed. Now, since this section applies to the public companies, private companies are not required to file the MR1. Okay, I'll just take a question so that it becomes relevant and I am in line with the expectations of the audience. It says a person has been appointed as a full-time director under 196, 197 in a public limited company, but not as a KMP under 203. Does the company still have to file MR1? See, practically, this KMP and MR1 are not interlinked. Okay. MR1 is filed under section 196. And for KMP, you have a separate compliance. Whatever is the compliance, but there is a separate compliance. So MR1 is the form that you need to file in the case of, you can say, in the case of under section 196. Since this is a public company, the answer to your question is yes, the company is required to file MR1 because you need to check schedule 5 part 1, which talks about the appointment. So this is the answer to Mr. Arjit Roy's query. Yeah. So we have one more query from Ms. Premalata Soni. Can a person be appointed as a CFO as well as CS in a company at the same time? Yeah. This is quite debatable, and I'm aware of both sets of companies, and I'm aware of both arguments that both type of companies have. I'll just go to that part under section 203. Just 1 minute, I'll just go to 203. Yeah. Yeah, I think so. This is the part that you're referring to. Yeah, so basically it says a full-time KMP. Okay. So if I have to take a stand that the company secretary needs to be a separate person and CFO needs to be a separate person, there would be an argument that because there is a reference of full-time, these two need to be a separate persons. Okay. But second argument can be that the person is having necessary qualifications, necessary experience, necessary expertise, and therefore CS and CFO should be the same. And there is no such restriction because it can happen in any company that a CFO is a director also, or a CEO is a managing director also, or a company secretary is a director also. So a person can have multiple roles to play. In my view, since the issue is not settled, in my view, there could be a situation that a company secretary and the CFO can be the same. But again, it needs to be backed up with a lot of research and you can say some background to it of why we can have a CS and a CFO in the as the same person. Now, I'm also aware of companies and my client companies also where they have done this, but I have just made them all clear that if at all you do this, then possibility is that a worst case scenario that we may have a we can say a communication from the government clarifying the situation, just to make them aware. But yeah, this is possible in case of certain companies. where there can be a double role played by a single person. So to answer your question, my answer would be to Ms. Premlata is that yes, it can be at the same time, or you can have the same position at the same time. So yeah, we are here. Just 1 minute. I'll just be back in just 10 seconds. Yeah. Okay. Great. So yeah, so it's good to have questions. It shows that participants are, as I said, participants are here for the true knowledge sharing and questions as well. Great. Okay. So we come to the next part. Yeah. This is a subsection 5, which says that if at all you can say if you go to the shareholders and the shareholders don't approve your appointment, then whatever acts you have done will be valid till that point of time, and then obviously you would not continue as a director because your appointment has not been approved. But again, this doesn't apply to a private company, because as I said, in the case of a private company, the shareholders approval is not required unless the articles require for the same. Voluntarily you can go, but statutorily not required. Now there is always a question that what forms are to be filed. Now I'm going to a very compliance aspect to it, but I need to go to that aspect. That what forms are to be filed. Now the typical question is, do we need to file MDT 14 in case of private company? Okay. Answer is yes. You need to file MDT 14 in the case of appointment, reappointment, renewal, or you change the terms of the appointment of a managing director. Okay. Now there is section 117, and there is one clause which you can say a private company is exempted from, but that doesn't apply over here, right? So this provision of filing of MDT 14 is applicable to the private company, and therefore private company or public company has to file the same. So that is a resolution. Now always there is a question that we have passed a resolution, but we have not entered into an agreement. So do we need to file the resolution, or we can skip that? Answer is that you have to file either a resolution or an agreement. Whether you enter into an agreement or not, you can always file a resolution, board resolution with the government stating about the appointment of the managing director. Now, most important part, one more point over here. That suppose if a company has appointed a whole-time director or an executive director, then the question would be whether you need to file the MDT 14. In my view, answer is not required, because you have to file it only for the managing director and not the executive director, whole-time director, or any other KMP, like a company secretary, CFO, CS, not required at all. So this compliance, I've come across 2-3 due diligence process where this compliance was not done. Appointment was weighed under 196, but this resolution was not passed and filed by the board. Now, interestingly, this resolution is the board resolution. So after the board meeting, you have to pass the, or you have to file the resolution. This is the important aspect of it. Now you have to, again, I'm repeating, you have to do it for appointment, reappointment, and renewal of appointment, which is as good as reappointment. Now, if a MD has been appointed for say 5 years and you reappoint him, then still you need to file the MDT 14 for the same in case of a private company as well. Yeah, this is another aspect, that when and how you can take these decisions. Can you do it by circular resolution? If there is an appointment of a KMP then you cannot do it by circular resolution. You need to pass a resolution in a board meeting. This is not part of the section, but this is part of the rules to the section. That is rule 8 of the particular or the corresponding rules. So any queries on section 196 till now? Most welcome to ask any query from any participant. I'll be more than happy to answer the same. Or I will start with the, or I'll continue the session, but it's not that if I go to 197, I will not discuss about 196. Anytime you can ask a question on 203, 196 at any point of time, we can discuss the same. Okay. So managerial remuneration, this remuneration has been defined now. Actually, it was defined under the Companies Act 1956 also, but it has been defined again now, but more specifically, and a reference to the Income Tax Act has been given. Now, remuneration is either money or equivalent to money. So it can happen that you do it in cash or kind, but everything will be remuneration. For example, insurance premium of a director or his family paid by the company, right? Accommodation charges paid by the company. Then transport charges, personal transport charges paid by the company. So all these would be remuneration in the case of a director. Now, this is just an example, but yeah, this has been defined in the Income Tax Act. Now, I may not go into the very basics of it, but just to put it very easily for all the participants, is that a public company, or I would just clarify one thing, that whatever we discussed for 196 is half applied for private company, half applied for a public company, or half, I can say, half applied for a private company, entirely applied for a public company. In the case of this remuneration under 197, everything is applicable to the public company. Right? So, and now as an auditor, you have to mention in the CARO that the profit has been calculated in accordance and the remuneration is paid in accordance with the company law. So it says that you have to consider all the directors over here. The ongoing financial year is to be considered, and you can pay up to 11% of the net profits. That's the maximum that you can pay. But there is another H over here, or another provision over here, which says that you can even go beyond 11% with the approval of the shareholders. So you need not take the approval of the shareholders if you are exceeding beyond 11%. You need to take the approval of the shareholders if you want to go beyond 11%. Now there is a provision where you can say 5%, 10%, 1%, 3%, but I'll not go into it. The reason is because even if you take the approval of the shareholders, you can even change the internal percentages also, right? Suppose if you don't take the approval of the shareholders, then the percentages are the same. But if you take the approval of the shareholders by special resolution, which is given in the red font, then you can have any combination of the. So interestingly, a company can pay 20% of the net profits as the remuneration, and internally it could be anything decided by special resolution. That is possible. I hope I'm trying to make you all understand what I'm trying to say. I may repeat over here. If you go to the first part, which is subsection 1, you can go beyond 11%. So you can go beyond 11%. You can say pay up to 25% of the net profits. Okay. With the approval of the shareholders by ordinary resolution. Okay. You can go beyond the limits, the internal monetary limits, by passing a special resolution. So it becomes more easy for the company. But please understand, this is what we are discussing is where the company has got adequate profits or has sufficient profits to pay the remuneration. If a company is into loss, then the said provisions won't apply. Then you have to apply a different provision, which is Schedule 5 Part 2. Now what they say, interestingly, I'll just mention over here, if you see in the first line, there is no reference of central government. In fact, reference of central government is completely removed from section 197. You need not, never in your lifetime, need to go to the central government in case of remuneration. So the time when there was so strict provision under company law for payment of remuneration, to the time where we are having a liberalized system or a liberalized ecosystem for the directors to pay the, to have the remuneration. It's a sea change over a period of time. So only thing over here that they say, you don't come to the central government, but at least ensure your other stakeholders are satisfied. So if the company has taken a loan, go to the bank and take a NOC. But please understand that is a prior approval and not a post facto approval. So the procedure is that you go to the NRC, take their approval, you go to the board, you take their approval, you go to the stakeholders, you take their approval, and then you go to the shareholders and then take the approval. Earlier, after shareholders, we were required to go to the central government, but now that is gone. If at all you want to change the percentages in the company. Now, the reason that I'm going in a bit of detail in all this is because chartered accountants have to give in the CARO, company secretaries have to ensure compliance as well. And lawyers, they will find out some way in which the compliance is not done and they can raise an issue in the NCLT. So if you are very, you can say, if you are very thorough with the law, you can easily find out what has been missed out in the law and you can make a case out of it in the NCLT. So I will also give a reference to that as well, because Rahulji is practicing in NCLT for quite some time, either under the Operation Mismanagement or IBC. Yeah. So we have sitting fees. Sitting fees. My question over here is now just to ask a question to the participants. Do you feel sitting fees is remuneration, managerial remuneration? Any idea or any views of any participants? Just to make it more interactive. Yeah. Yeah. So Mr. Ashish Kumar says no, not. Yeah. So to make it more clear, or what would be my view is that sitting fees is remuneration. Only thing, it is excluded from the calculation of remuneration. Okay. So whenever we are disclosing remuneration, you put it in all the schedules, you put it in the related party transactions, you put it in the director's remuneration as sitting fees. But whenever you're actually calculating that remuneration, that time you're excluding. So therefore, sitting fees is remuneration. Only thing, it is out of the purview of the calculation. Now, whether sitting fees is included in the remuneration, answer is no. But to give a quick background of it, that sitting fees of 1 lakh rupees per meeting per director is the maximum sitting fees that we can pay. If at all, the whole time the independent director and a woman director is paid a bit less than that, then that becomes the threshold. You can't go beyond that. Now, this clears everything. This even includes committee meetings. So if you have got audit committee meetings, CSR committee meetings, remuneration committee meetings, board meetings, AGM, all this would be considered as a meeting and the remuneration can be paid and will not be part of the total calculation. Yeah, so if you have got inadequate loss, go refer to Schedule 5. Schedule 5 now has a provision for the managerial personnel and other directors. So if there is a, you can say a managing director, whole-time director, non-executive director, independent directors, all are covered under the Schedule 5 Part 2. Everybody can be paid. This is an amendment that was introduced in 2020-2021, where the remuneration can be paid to the non-executive directors as well in case of loss. Because practically, to give a very practical perspective, that remuneration to non-executive directors is always part of the profits. But if the company doesn't have profits, then how can they have the remuneration? Therefore, they have put it The criteria over here is that you need to have a net worth of a certain amount, then you can pay. I'll come to that a bit just in some time. Yeah, this is a very important aspect, and this probably is this is known or maybe not known to few participants or few professionals of what this any other capacity is. Before going to that, just quickly understand. Let's quickly understand what this is. Right now, whenever a director, I can just to give an example. Whenever in a hospital that is a company and that hospital is a public company, okay, in that you have a doctor who is a director, okay. Now he performs certain operation and certain surgeries in the hospital. Now he will be paid a lump sum package of say 3 lakh, 5 lakh, whatever is the lump sum package, irrespective of how much time he gives to the company and how much surgery he performs, okay. But practically, whenever he is in the operation theater, that time he is providing the services of a doctor and not director, okay. Therefore, he is providing the services in any other capacity, okay. But the question over here is that can he be paid in the capacity of a director? Answer is yes, which is provided in section 195 subsection 197 subsection 4. To give some background, it says a remuneration payable to a director shall be determined and shall be inclusive of remuneration payable to him for any other services that he renders, okay, in any other capacity. But now there is a precondition to that. It cannot happen that every other capacity can be paid, right? Firstly, the services are in professional nature. That is the first criteria. And second criteria is that the NRC or the board should opine that the director possesses requisite qualification for practice of profession. Now, to just give an example, I'll just give 2 examples and everything will be clear. For example, there is a chartered accountant. He is a director in the company. Now, he is providing directorial services whenever there is a query. Now, if there is a GST matter or an income tax matter, and he represents the company in the tribunal or the court, right? Then he is providing chartered accountant services or a legal professional services and not the, you can say, directorial services. He is providing the services in a different capacity. Therefore, it will be the remuneration that will be paid in the other capacity. Okay. Now, whether the services are professional nature, answer is yes. Whether he possesses requisite qualification, if he possesses a practicing chartered accountant or a practicing lawyer certificate, bar council, then he would be taking the advantage of the same. So that's how this provision is there in the case of, you can say, the payment in case of any other capacity. There are 2 conditions. Earlier, this opinion was required that of the central government, but now the laws have been changed and now the requirement is that of the NRC or the board. This is again a very interesting point, section 197 subsection 6, because it says that you can pay remuneration by monthly payment or by percentage or by partly by one way and partly by other. So the question here is, can a managing director be paid in 2 ways? That is, he can be paid salary as well as he can be paid a part of the net profits. Answer is yes, this is possible. This is possible even in the case of a non-executive director, because the provision starts with a director. It doesn't start with a non-executive director or an independent director or any kind of director. So you can pay in any form. This was not the case under Companies Act 1956. If a non-executive director was paid a monthly salary or a monthly payment under 1956, then it was required the central government approval. But now that is not the case. It can be done in the present situation by the requisite approvals. Yeah. So we have the remuneration to independent directors. Yeah, so we have the remuneration to independent directors. Obviously, they can't be paid ESOPs. They can be paid sitting fees, obviously. They could be reimbursement and profit related commission, which is the, you can say, part of the profits that they get. Excess remuneration, they need to give it back to the government with or without the prior approval of the central government. That can be done. Now, if there is, you either need to take the approval of the shareholders beforehand or at a later point of time, which is there in section 197 subsection 9, if you have paid an excess remuneration. The company cannot waive the recovery. Only thing here the central government comes, that either you recover or you go to the central government and say that okay, recovery is not possible. So to waive the recovery, then only you need to go to the central government. Again, you have the same kind of approvals over here as well. So in case of no profits or inadequate profits, we have already discussed this part over here earlier. Yeah, this is what I was referring to. Now under section 143, an auditor is required to make a statement whether remuneration paid to the directors in accordance with this section. I think so CARO has also been amended to this extent, that whether the remuneration paid to the directors is in excess of the limit laid down under the section. So please understand that this provision is applicable only to public companies and the provision is not applicable to private. So this clause won't come for the private companies as well. Yeah, so Schedule 5 Part 2 has been completely revamped. So you can just take that part specifically where the remuneration is to be paid to the managerial personnel as well as other directors. And that other director means the, you can say, non-executive directors. Now, see, this is also one more important amendment that was introduced by the government just a few months back, where they said that you can pay you can say a managing director who is in the professional capacity. He is not from the promoter group. So government is again promoting this, even through SEBI also they are saying that MD and chairman should not be the same. Similarly, they are having a provision where if a MD is not related to the chairman or the promoter family, then he can be paid remuneration as well. Yeah, so we can have a formal Q&A. Considering my health, I have not prepared a very exhaustive, you can say, PPT. But if there is anything, any query of any participants, any more queries of any participant, I'll be more than happy to have the queries or any points. You can unmute and ask the question as well.
I think we have mostly taken all the questions from the chat box. Right?
Yeah, I think so. There were some few questions. Yeah.
So if you can just, regarding the compliance part, so what are the basically approvals required with respect to the payment of this managerial remuneration? So if that particular approvals like
yeah,
whether audit committee or
correct.
NRC committee, so
yeah,
these aspects.
Yeah, so in case of private company, even if we take the approval of the board of directors, if the articles are silent, that is more than sufficient. In case of a public company, we need to take the approval of the NRC. We need to take the approval of the board of directors, shareholders. And in the worst case scenario, in case of waiver or that would be the approval of the central government. But other than that, not any approval. But for a listed company, you have to ensure strict compliance of how much amount approval you take and how much amount you pay. So it can't happen that you have taken an approval for a lower amount and you have paid a higher amount to the directors. So approval of is required. Like for example, I will give an example of chairman emeritus. So we have a concept which is there now in the business parlance. So he's a chairman emeritus. So he's sometimes not on the board, or he's on the board as a formally appointed director, but he guides the company, he leads the meeting, and he's paid a salary for this particular, you can say, particular activity. Now, again, that is under the question because he is not on the board. In some cases he is on the board as well. So it is as good as he's an executive chairman of the company. So if he is an executive chairman, he is an executive director. And if he's an executive director, everything applies as we discussed right now. But again, the question would be about his role and responsibilities, and most importantly, his liabilities. Because what has happened, the chairman is generally the person who is chairing the meeting. Like, to give an example, we have got Mr. Rahulji, who is the chairman of today's meeting. Okay, or the president of this institute is the chairman of this meeting. Okay, now they are just the people who are facilitating the proceedings. They are not the people who are actually involved in the decision making during the session. Okay, so therefore they will not be held liable. That is that is where the crux is. That what is the role that they have in the company. So these are very fine tuning or finer issues. But yeah, chairman emeritus, in my view, is a position which is still under, not doubt I can say, but still under consideration. MCA is also considering.
I mean, the law as such does not considers that.
Exactly. Yeah.
Exactly. The company law does not considers that. So basically, a kind of a honorary position which is given to a person.
Correct. And like, sometimes I have seen that in some cases the proxy advisory firms are not objecting to it. They're saying, okay, that's now a routine thing now. And in some cases, proxy advisory firms are taking some, not action, but they are saying that they are flagging off, saying that, yeah, how is he there on the board and how much he's paid and how much he's contributing. Because now everything what has happened is everything has gone in a matrix, that what is your contribution and how much you are paid. So therefore in that way. And also there is one more important point, that whether it amounts to control. Okay, that whether having a chairman emeritus on the board amounts to having control by the chairman. Because if he is ultimately going to take the decisions, then it is as good as he is the executive position and not a non-executive position.
And one question which I have is with respect to if there is a holding or subsidiary. So in that case, I mean, is the director allowed to take the remuneration both from the holding and subsidiary? I mean, how that position will be dealt with?
Yeah, I think under 197 there is a reference of this holding and subsidiary. It is, you can take the remuneration. Only thing, it is subject to the disclosure requirement for the holding company in the board report.
Okay. So 134 we have to disclose in section 134.
Yeah. Under 197, I can just quickly tell you which provision it is. No, probably it would be in the rules, but it is under the provisions of 197 or the rules, where it talks about the disclosure part. Yeah.
So I think that is the takeaway. I had these two particular questions. So, so if anybody has any other question, they can just unmute themselves. And I think Gaurav Bhai has done wonderful. I mean, through the PPTs and the board. Yes, I think somebody was attempting. So you are having a sore throat, I think, or
yeah. Actually, for a very long time, I'm under medication. I can actually talk for say 45 minutes or 50 minutes or 1 hour. But generally, what has happened is in the recent times, my lectures have reduced. So
Yes, sir.
I don't feel comfortable by not giving lectures. So
So one of them is asking for please share the PPT.
yeah, sure. So
So
after
that
this,
will be shared, sir, because we have the email ID when you log in the Zoom. So we have the email IDs.
yeah,
So I will ask the ACA office to circulate it once Gauravji shares with me. So I will ask to circulate.
yeah.
So I think that was all from the side of Gauravji. You have
Yeah.
yes.
So thank you, the ACAE Institute, CS Rahulji, CS Sumit sir, Niti who was coordinating for all the information and all the team members for the invitation. It was good to interact with all and hope to meet you all sometime in person in Kolkata or any other.
Yes, sure. So I would also personally like to take an opportunity to give you a heartfelt vote of thanks. On a short notice, you have agreed to speak on this. So we'll definitely have an opportunity to host you physically here in Calcutta. So it was a wonderful session all throughout, and listening you on this unusual topic with respect to managerial remuneration, because this is a topic which generally people have quite a doubt with respect to this, because calculation issues are there, that what things are there, compliance issues are there. So there are many things which crops up, and then one has to refer to some Ramaya, or then after that, then once. So it was a quite a unusual topic as well, because we will find very few people speaking on this particular topic of managerial remuneration. So thank you for gracing us with the time on this particular subject. So thank you, Gauravji, once again. And I would also share with you our e-memento over the email. So thank you.
Sure.
That's
Thank
all
you.
from the ACA.
Yeah. Thank you,
And
Rahulji.
just share the PPT over mail to that
Yeah,
info.
I'll do it.
I just circulate.
Yes. Great. Okay. Thank you, Rahulji.
Thank
Talk to
you,
you
sir.
soon.
Thank you.
Yeah.
Yes.
Okay. Thank you.
You can leave, then we'll end the meeting.
Sure.
So thank you, everybody.